Let's just get started with this. So today we're going to talk about Ashtead, a construction rental company. They're based in the UK.
Equipment rental company.
Equipment rental company. I'm sorry. Yeah, you wouldn't believe how many times you've had to just do this one take. Right. So to give the breakdown, we invested in this business back in late 2017, and we decided to write about the company earlier in 2018. And since then, a couple of years has gone by. A lot of stuff has happened, and including the COVID pandemic. And at this point of the year, we thought, let's start revisiting some of our businesses that we have invested in. And this is why we're here. So we are going to have a quick run through of Ashtead as a business, just give a quick run through of who they are, what they're about, what they do, and an update on how the business and how the business has changed since we initially invested.
And we're here on our website, hpvalueinvesting.com. So if people want to find the report, it's, oh wait.
Want to go to reports?
It's under reports, not under blog. I actually just added this report 30 minutes ago.
Excellent.
So you can go here, and then this is the report we wrote in February 2018. Yep. Do you want to give a bit of an intro about the company, sort of just to a little bit about the markets they operate in, what they do?
Yeah. So Ashtead, they rent a bunch of equipment, second largest in the world. They have operations the largest operations would be in the US. They also operate in UK and most recently Canada. What else do we? And in terms of the equipment they rent, there's all sorts of stuff. So we've seen stuff in our day-to-day life in walking around London that, construction equipment. But they also range to little handheld tools, and they also have specialty lines as well. So things such as heating, flooring. So a big range of equipment we're talking here.
There's a picture here that you can see the kind of the different things that they have. I guess those large cranes would be the most typical things, and then everything from that to like floor cleaners, and as you said, like handheld tools like drilling tools and all that sort of stuff. So anything that you can imagine that you would want to rent, like equipment, they do it. And what's interesting about them is that, but I think they said that 70% of the rentals are placed within 24 hours of needing them. So imagine that, like, you need something and you're placing the order within 24 hours. So then basically you get it probably the next day. So it's like a product that people need, because imagine that if you have, for example, there's like an event and you need equipment for that, and the event is the next day, like you're in need of that equipment. So that's a pretty good position for Ashtead to be in, that they have products that the people really need, and they're also very big on customer service. So it's very important for them to provide very good customer service, which I think is a reason why the business is doing so well. So that's kind of just to give a summary of what they do.
It's something that drew us to Ashtead in the first place. I mean, as value investors, of course, we want to look at the financial side, the management side, but we also want to look at the service element. I mean, this is not just the products that they offer, but it's also the service that they provide to their customers. And something like a 24-hour turnaround period is quite what would you say, is a competitive edge. And it's nice to know that since our initial investment, they are still delivering within 24 hours. And then in terms of not market share, in terms of operations, North America would be their biggest operations, where they have 87% of revenues come from the States.
I think it's actually up
And
to 90 now in 2020.
really,
Yeah, it's grown a lot.
Yes, I thought that's probably more just to give an indicator that bulk of their operations are going on in the States. And then I suppose I was still going through our initial report, right? This is the report from 2018.
Well, yeah, these key figures are kind of out of date because that's sort of like at that time. But I guess, we could mention our investment thesis, like why we looked at the company in the first place.
Yeah. So one of the main, I was just thinking, who's going to start here? One of the main things we wanted to look at was the management. So we did a bit of digging around into the CEO, Jeffrey Drabble, and his strategic decisions over the years. He's under his management, we discovered that he's managed to grow the US market share from 2% to 7% at the time of writing. And that tells us that he's quite a capable CEO. He seems to know what he's doing. And that was one of the biggest factors for why we wanted to invest in Ashtead. It's all well and good having a project that does well, but the management can make or break a company.
Right, but it's also important to note that that's absolutely one part of it. But the situation now that we realized is that he actually left. He left last year. Now there's a new CEO who has come in, and he used to be the CEO of the US part of the business, which is good because if the US was 87-90% around there, if that was of the basically the whole business, and that the new guy Brendan Horgan, if he's in charge of that part of the business, that he's probably a pretty capable CEO, and they have been growing since then. They still have good margins, which is an important thing, because when we looked at this, it was it's a growing industry. It's one of the best operators. They have growing revenue. So I'm just looking at my phone here, and then high margins and high free cash flow. So it's not just CEO, but it's also that they have very good financials as well. So that was a very important thing. That was that we looked at in the beginning. Yeah, and none of that has really changed. I would say that it's stronger than ever, it seems, from when we looked at the company first.
Yeah, and the financials, that we will visit the financials in a bit more detail later on, but this was just to give you a bit of an overall heads up that the business is good. We like the management, even with the change in management. The company is still delivering a good product. It's still producing those margins that we're looking for, and it's growing in its market share, and it's one of the most solid competitors in its market.
Yeah, I would say it's from what I've seen, it's the best, and we're gonna kind of move on to looking at Ashtead versus its main competitor, because it's we can kind of see that it's. I mean, the thing about the Ashtead is that it's in a growing market. I think that's an important thing to note, that there's a trend to rental, especially in the US, where companies are more and more wanting to rent as opposed to own the equipment. Because when you think about it, is that owning equipment means that you actually have to do a big cash outlay, and you have to put that on your balance sheet, and that requires maybe you have to take up debt to buy equipment or a machine or something like that. So if Ashtead can provide that, and then they can provide it, as we said, within 24 hours, and you can just hand the equipment back to Ashtead in the end. Like that's a very good value proposition. You don't need to buy it and put it on your balance sheet and potentially borrow money for it. So I think it's a very good value proposition, and it's in a growing market, because I think they said there's about like 55% penetration in the US, and for comparison, they say it's 75 in the UK. So if it would go from 55 to 75 in the US, then there's a lot of potential for growth. So there's like this tailwind in the industry, which is very important. And that, because there's a tailwind, that allows Ashtead to grow and grow, and then they keep capturing market share. And in this business, scale is important, because then you're able, because Ashtead has to go out and have to buy the equipment from the producers, and if they can buy the equipment cheaper, then you know, their margins will be higher. And also, the bigger the company is, the bigger their sort of they have this kind of thing that they call the cluster approach, where they have a lot of clusters of stores within the same area. So they're able to provide the customers with a wide range of equipment if they need that. So the scale is very important for the company. So the bigger Ashtead grows, the stronger it grows, and the more the competitive advantages they have. And they're very big on technology. And I think the more the bigger you get, the more money you have to invest in technology, and then you can kind of, the better your tech is, the more you can kind of take away. What am I trying to say? Like, you know, a smaller competitor, like a small local competitor, won't be able to have the logistics and the technology that Ashtead has. So that's
either that. I mean, either that, or it would just be the cost will outweigh the benefits, because Ashtead is such a huge company. They're going to benefit from having an app that's going to let people take measurements or use this digital framework that they've got in place.
Yeah.
It just benefits on a larger scale. And one more thing, just to go back to that cluster strategy, I think, again, with the growing market share, as you already mentioned, you know, the more market share you have, the more stores you can open, and with more stores, the more that they can leverage this cluster strategy and have these clusters of stores dotted around. And you know, why are clusters such a game changer, or why is it so successful, is two things. One, clusters will increase your brand visibility. If you can imagine, you're in a particular town or a city and you see Ashtead or Sunbelt brands just dotted around in different local areas, you're going to get that, even if it's just a subconscious brand awareness. And then the second thing is interaction. So interaction between the stores is easy. If you imagine one store is renting out drills, and another store is renting out, I don't know, let's say forklifts, for example. It's quite easy for the forklift store to want to get the drills, because the stores are quite close by each other. So in that way, you've essentially got a whole bunch of different stores that have access to a broad range of equipment. And I think that's very powerful. So I just wanted to pick that up in terms of the cluster.
And we should, you can probably move on to comparing the different United Rentals to Ashtead. I'm just trying to pull it up on my screen here. Wait, how do I remove this? Sorry, I'm just like, this thing that's recording is just like hovering above there.
It always happens whenever you're recording.
So United Rentals, that's the main competitor. So that's the biggest player in the market. So we just wanted to compare this company to Ashtead, and because it's good to see how the companies are doing, because if there's one company that's doing better, if they have a higher margins, they're making more money, or a higher return on equity, something like that they're usually doing something different. And if they're doing something different, if they're better, then that can compound over the years, and they will keep capturing market share. And I want to invest in the company that's the better one. I don't want to invest in the one that's lagging behind. So this is a website called Ticker, and it's a good website to kind of compare the different, to get the financials of companies. So you can compare the financials of one company. So I just pulled up the revenues of United Rentals, and I can do that for Ashtead as well. can kind of see, I mean, if we can, let's do it in the line. From the revenue perspective, we can kind of see that they're growing in tandem. There are certain times when United Rentals is sort of, it's kind of taking off, or it's like the difference between the two lines is higher. So they're kind of making a higher revenue, but then you see in the financial crisis kind of came down quite a bit, and Ashtead didn't come down quite as bit. And then after the financial crisis, it started taking off again, kind of the revenue. So I looked at this and I was thinking, there's not that much you can glean from this. I was thinking, is there one company that's sort of eating the other company's revenues? And I just can't see that here. Both of them are growing pretty decently. So I didn't feel like I could kind of see anything that was specifically telling here. Like they're both growing well. And then the other thing I looked at was if we look at
I just think it's okay as well. I was going to say it's okay. It's not a case that one company necessarily has to be eating somebody else's share. Like you already mentioned before, Lars, it's this is a growing market. So
yeah, and that's probably why we're seeing it, that it's a growing market, and therefore there's not one company that's kind of dominating, that they're both growing together. Like United Rentals market share is growing as well, because I think they're taking market share from the smaller players. As we mentioned, if once they get bigger, then once the companies get bigger, then they can benefit from what do you call it? Scalability.
I have a quick question, right?
Yeah.
Just for our viewers as well, is around 80, we said around almost 90% of Ashtead's Ashtead's revenues are from the US. Is United Rentals also based in the US?
Yeah, that's a US company. They are in, if I remember correctly, I think they're in US and Canada. They're not in the UK, which Ashtead is. So yeah. So
they're competing in very similar, if not the same, environments. Okay.
Yeah.
That just gives a bit of context to the numbers we're seeing here as well, that it's not you're operating in completely different geographies. Cool.
No, they're directly competing. By the way, my camera turned off and I'm not able to turn it back on again, so whatever.
What do we have here on your screen?
So that's the operating margin. Again, the operating margin is a good kind of like a sense check of if a company is doing well. I like to see, or we like to see, like an operating margin above 20% is, I would say, really good. I mean, even above 15 would be decent. But we can see here that kind of there's not that much difference either. You can see that in the last couple of years, Ashtead has kind of done a bit better, and yeah, I mean, in the financial crisis, it was slightly better there, but again, there's nothing here that sort of tells me that one is just definitely better than the other. It's just they're kind of they have different margins at different times, and they both done really well over the last few years, which is probably because the market is growing and they're both benefiting from that.
So it doesn't look like there's a clear answer. And just to be clear, so just squinting a bit, Ashtead is the orange line, right? And then United.
Yeah, correct. Yeah. Okay. Correct. But then it gets interesting, because if you go down to not that one. If you go down to, if you do net income, you can see quite a difference. And I think this is quite interesting, because you see United Rentals had a huge dip in 2008. So the fact that it went down to almost a negative 30% margin, while Ashtead had a decent margin, I think that's quite telling. The fact that I think Ashtead only had Ashtead actually didn't have any negative margin, although there were like very small margins in 2008. Like, that's quite good to see, because when you see a company that's not losing money, even though it's in a very difficult period, and you see the competitor is losing more money. Like that's a pretty good thing to see. And I think also if you actually zoom in, like because these negative numbers distort it. So I think if we go to just zoom in on that, you can kind of see that Ashtead is actually doing much better in terms of the net income. Like most of the time, you can see, for example, 14 versus 10, like here, or almost 15. That's a big difference. That's like 50% higher. And you can see the same thing here, like 26% margin versus 13. Like this to me is much more of a clear indication that Ashtead is doing better.
Right. So just to summarize that bit there, when you look on the larger scale, it appears that Ashtead's net margins they're increasing, but they're also a lot more stable than United Rentals, is what we're doing here. Apart from the last few years where we're not going to complain if Ashtead's net margins are higher than United Rentals at this point. And it'll be interesting. I have a few reasons or inklings as to why they were able to maintain a positive net margin in more pressing years, and I'm wondering if that's to do with their strategy as a business in terms of how they manage their spending. So we'll probably go into that a bit later on.
Yeah, I don't actually know off the top of my head. I mean, back in 2008 is the company changed quite a lot since then. Like they've been going from strength to strength, and they did mention that in 2008 they didn't handle it as well as they should have because they took on too much debt. So after 2008, they sort of focused on deleveraging. So I think that the company today is not the same company as it was 12 years ago because they learned from their mistakes. So they're kind of even stronger than before. And coming back to that, like on the topic of that, if we just go to actually the ratios and we look at, speaking of debt, if we remove that, and we have to zoom in because there's some numbers that are distorting it, but let's see.
Right, so Ashtead is the green one, right?
Yeah, green one. So you can see, I have to zoom in there to show it, but you can see here that it's kind of that's a big difference. Like a debt to equity, I mean, I kind of like to have it around 100 or below, but that's that's not a hard and fast rule. But you can see the difference here. Like if their debt is like the United Rentals is above 300, it's like 300, 400%. So they're using way more debt to achieve their results, and Ashtead is just way more fiscally responsible. And I think that's especially important in these days because with COVID and with everything that's going on, and just with the uncertainty and just in any recession, it's always good to have a stronger balance sheet. So when I see a company like this with United Rentals, when they have more debt, like that automatically just tells me that I prefer Ashtead because we're the kind of investors who like companies that have stronger balance sheets because it's kind of like downside protection.
And having a quick look at the most recent earnings call, there was even mention there of, obviously given this COVID situation, was it Ashtead's, they chose to reduce their capex, so reduce their spending, and then use that to start paying off a bit more of their debt. And even that's even right now showing that even in these times they're still being responsible around their debt when money can be a bit tight.
Yeah, it's we'll get to that later, but they definitely the interesting thing about them is that their cash flow is higher during down periods like this because they stop spending on like growth capex, meaning that growth capex is when they're growing for growing the business. And when they stop spending all that in tough times, they cut a lot of the capex, and it means that the free cash flow actually increases in recession periods, which is a very good thing to see. So,
and for
yes,
background,
sorry,
I was going to say, for background, what is the capex of Ashtead like, just in an average year?
In an average year, I think it's
Is
about
it quite high? Is it, you spend a lot?
Yeah, I mean, you have to put it into context, but I think the capex is about like 1.5 billion pounds.
There's a lot of spending in a year then.
Sorry?
It sounds like a lot of spending in a typical year.
Yeah, well, I mean, that depends on how big the business is, but it is a lot of spending compared to that business. I mean, the market cap of the business, I think at the moment is about 14 billion. So that kind of puts that into perspective. And I think their revenues are around 5 billion or something. So yeah, it's definitely a decent amount. Like, it's a high capex business because they have to buy this equipment. But I think that's where some of the value proposition comes in. Like, they, as we said earlier, they buy the equipment so that the customers don't have to, and that's where the value lies for the customer.
And it's in times like these that because of that reason, they can afford to drop their spending in times like these, and their cash flows won't be too affected.
Yeah.
And to work in their favor.
So just one last thing I wanted to look at, which is the return on assets. Just look at all the assets that they have, and then the return, and that kind of tells you how much profits do the assets generate. And you can see here, I'll try to do a longer timeline. You can kind of see here that they were doing the same, and then in the last, I mean, since about 2012, you can see that Ashtead is just kind of taking off, and that's a really good thing to see, that they're generating more revenue. No, sorry, more profits with the assets that they have, and the fact that they're doing that with less debt is a very positive thing. So that kind of tells me that you know, given what we looked at, like, I definitely prefer Ashtead. Like, I haven't done a deep dive on United Rentals, but if I had to choose, it would be Ashtead all day, depending on or based on this analysis.
And that's the thing, like, all of the little pieces come together. It's never going to be just off the basis of one metric. You're going to look at the margins, you're going to look at the leverage, you're going to look at the competition, cash flows, and that is what ultimately paints the picture. And when we looked at this, and when we look at it now, we still feel that Ashtead is a strong company. Yeah,
I think that should probably that could lead us into looking at the latest results. So I'm looking at some of the notes here, and we covered a lot of the stuff. The 2020 annual report that recently came out. Like, we mentioned most of the things from there, and I think given the situation with COVID, it's what's important is to look at the most recent results that came out. It was 8th of September this year, so that kind of captures the whole COVID thing. So and what's good about Ashtead was that they didn't furlough anyone, so they didn't let go of any of their employees, which I just think, in terms of just as a good thing to do, like to actually keep your employees in a difficult time like this. I think it's just good on them for not letting go of their employees who need the salary in this difficult time. And I also think it's a good thing, because then they don't have to rehire people back when when the market comes back. Sorry?
Yeah. I was just trying to finish the sentence.
Yeah. No, exactly. So that's a good thing. And I think also it was I think a lot of kind of construction and stuff like that was still open, especially in the UK, and I think in the US as well, while this COVID thing was happening. So they were kind of, to some degree, seen as an essential business. So the financials of the business weren't that bad during the first quarter of this year. And when I say first quarter, it's important to note that the financial year for Ashtead ends in April. So the first quarter was May, June, July of this year, when it was like a full lockdown in the UK and
in the States as well. There was quite a big lockdown there.
Yeah. And also one thing to note is that they didn't take, here in the UK, you could get help from the government, and they didn't take any help from the government either, which kind of shows the strength of the business. So that's a very good thing. So I'll show, I'll share another, share this one. Can you see that?
Yes, I can.
Yeah, so this is the presentation, right? Of Ashtead. So you can actually see here that.
Bottom right corner.
Sorry?
I was just going to say we can see the date down the bottom left-hand corner, so we know it's the first quarter.
Yeah.
Yep. Lovely.
So this was for May, June, July. So kind of at its worst, and you can see that from first quarter 2019 to 2020, the revenue only went down 7%, and I mean that's not too bad considering everything that happened. Now, obviously, operating profit went down 30%, so and earnings per share down 33%. So obviously they were hit as well. But what's interesting to see, as what we mentioned, is that we said earlier, like an operating profit margin of more than 20 is pretty good in our book. And you can see down here, I don't know if you can see my mouse, but here it was in first quarter 2020, the operating profit margin was still 22%, down from 29%. So that shows you how good of a business it is, because most companies won't even achieve that ever. I mean, a lot of companies have operating margins below 10%. So kind of in the middle of COVID, having an operating profit margin of 22%, that's a good number.
Yeah, that's impressive when you consider not just the revenues falling, but the fact that the operating costs are slightly higher. And I remember reading in their earnings call that part of that would have been down to not furloughing, of not taking advantage of the government furlough scheme and not laying off staff, and to get 22% after that. Yeah, it's impressive.
It is indeed. And then, so this is just a different, I was just going through the different countries, but this is what I mentioned earlier about the cash flow. So again, you can see the quarter on quarter change. And so can you see when I highlight that?
Yes.
So if you actually see, so the cash flow from operations was basically the same in both quarters from last year to this year. It's 542 versus 543. Yeah. And then what you can see here is that you can see that the replacement and non-rental capital expenditure, so that kind of like the replacement, not the growth, but the replacement is lower. So what they're ending up with is actually a higher cash inflow in this quarter. So it was 366 in 2019, first quarter, and this quarter is 447. So even though we're looking at if we look at the profit and loss, we can see that the profits are down, but actually, the profits, that's an accounting number. But when we're actually looking at the cash flow is actually increased in this quarter, which is quite good, which is very good.
Yeah, it's a massive difference. And that's all coming from being able to drop your CapEx.
Yeah, well, that's the CapEx here. But then also what we see here, then, because they split it up into replacement CapEx and then growth CapEx. Right. You can see here that it was 205 last year, but they have no growth CapEx. So the free cash flow after free CapEx, after the growth CapEx, they call that free cash flow. That was 447 versus 161 last quarter. And you can also see that business acquisitions, which is kind of, well, it's not a CapEx, but they do a lot of smaller acquisitions to kind of grow.
That's right.
The business. They did 205 million of that last quarter or quarter last year versus 12 this year. So at the end of it, you can see that they're left with 422 million cash flow this quarter versus minus 186 last year. So when you actually see the difference in when you actually look at the cash flows, you can see that the company is actually doing really well.
Yeah, and if I'm reading that, it says decrease in net debt. So does that mean that cash was used to reduce the debt then?
Well, yeah, well, it's net debt is just debt minus cash. So if your cash is 422 higher than last year, then you just decrease the net debt figure by that. So it isn't actually that they haven't. I was actually a bit confused by that as well, but I realized it's just a way of saying it. It basically just says that's the extra cash that they have after this quarter, but then net debt is net money. Yeah. So
I mean, they could theoretically do that, but it doesn't mean they are reducing the debt.
Exactly, yeah. Net debt is just like a way to present, you know, do you have more cash or do you have more debt? That's kind of the main thing of this quarter. You can see also they've been reducing their leverage, which we talked about from in the financial crisis 2008. They had quite a lot of debt, and now they've been decreasing that debt, and they have that in sort of like a comfortable range. So the balance sheet is quite strong.
And part of their strategy was that they wanted to keep their leverage at around about 2, wasn't it?
Yeah, between 1.5 and 2. Yeah, so they're comfortably within that range. And looking at how much free cash flow they can generate, that's sort of, I mean, that's kind of okay because you're able to pay that down.
So far, it looks like our updated on Ashtead, our updated analysis is the numbers are painting a nice picture here.
Yeah, so I think I also looked at had some numbers here. I looked at the financials of the annual report, which is up to 30th of April, so it didn't capture all the COVID thing. But again, the cash flow there before the growth capex was about 1.5 billion pounds, and currently the market cap is around 14 billion. So the price to free cash flow, just based on that, is about like 9.3. So you can imagine when a company is sort of in the middle of a financial crisis and they're able to increase their free cash flow, and they have a free cash flow of 1.5 when the market cap is around 14. Like that's a very good number. But anyway, I mean that's kind of I think that's more or less the summary. I mean, at least for me, that was kind of the thing about Ashtead, was that, as you mentioned, we first invested in December 2017 at about 19 pounds, and then we held that, and then we invested more in March 2020 at about 11, a little bit over 11 pounds. Like, I mean, the share price completely tanked, and I mean, we were really lucky to buy in at that point. I mean, it was somewhat skill as well because we did have the guts to do it, but at that time it's really scary to do it. But now it's back at about 30, 31, 32, I think. But I think the point about this is that I'm happy where the levels that we got in at back in that you know, in March this year, and also in 2017. But given this given where it is now, I'm happy to hold it, but personally I don't think we would invest more at this stage.
At this price, yeah.
No, because we did the valuation. We haven't showed this here, but we kind of did our valuation in our sort of models, and a fair value estimate would maybe be around 35. So it's kind of getting up to that point. And even if it hits that fair value, it doesn't mean that it's worth nothing. It just means that it's, you know, it's still going to generate a return for us. But it's not really undervalued. So at this point, we would be more comfortable just holding it and see what happens, because it's impossible to know what's going to happen in the market. But if we try to sell now and then try to get back in later, like that's really difficult. And then we're sort of doing market timing, and that's not really our strength.
That's not how we. Yeah, I mean, that's not us as investors.
No, that's a really difficult game to play. So I kind of, yeah, that's kind of like the summary, because given everything that's happened, it's good to have an update on how the company is doing and to see kind of how they're doing through COVID. And as we can see, they're doing pretty well. So, you know, I'm happy to still be holding holding our shares. And then at some point, you know, wouldn't surprise me if they fall in price, then we'd be, you know, ready to potentially buy more.
Yeah, keep a beady eye out for that.
Hmm.
But all
Actually,
in all, sorry?
No, you go.
I was going to say, all in all, it's actually quite nice to revisit a company a couple of years on just to see how it's changed. Because now we can see, okay, this is this part of the strategy, or these numbers have stayed consistent, or they've moved up or down. It's quite interesting when you're revisiting a company rather than researching a company from scratch. So that's all I wanted to add, that this process has been fun for us.
Yeah, and I think what I liked about it is that I remember when we did the first analysis back when we wrote the report in early 2018, or when we, you know, read about it in 2017. Like I remember that we could see that it was such a good quality company, and you can see that kind of the stuff we highlighted back then in our report, that's still valid today, or even, you know, even better. So it kind of just shows you the benefit of investing in quality companies, because they're sort of going from strength to strength as opposed to sort of deteriorating. So that's one of the benefits of investing in a quality company. But I would also mention one last thing, that in the 2020 annual report, they did mention that they were expecting a downturn even before COVID, because a lot of their operations are in the construction industry, which sort of, as they say, when there's a recession, it kind of turns down, like that industry sort of starts turning down 12 to 24 months after the rest of the economy. And they could already see signs in the rest of the economy that was sort of pointing to it turning down. So even before COVID, they were saying, you know, there might be a chance that it's sort of, that it's going to be a bit more difficult going forward. And it is a cyclical business. So if you then put COVID on top of that, like, I think it's very important to be a bit vigilant, because it seems like people are kind of thinking that this that the economy or the world is just out of this recession. I mean, it's a recession kind of usually never lasts shorter than 18 months. And then you have this sort of big crash in March, and then there's, you know, shitloads of money printing just being pumped in, and then the markets just go up again to new highs. And people are just thinking that, oh, there wasn't even a real recession. Like, I think the actual economic hit, like, that might come soon, like when companies really start to go bankrupt, and that will hit the industry, that just the economy in general, and that will hit Ashtead really hard. So it would definitely not surprise me if there's going to be some really tough times ahead.
I guess we just got to be prepared for that, keep an eye on the numbers, and again, you look out for opportunity if we see it.
Yeah, exactly. Be ready to, if it goes down, then be ready to buy more. And even though it's uncomfortable to see the, you know, your stocks go down in value, then if you're sort of holding that cash position, that's fine. But what I would not do is sort of, if you're interested in this company, then, you know, take all the money you have invested now and then not have enough money to buy more if it goes down, because then your future return will be quite bad.
Sorry?
No, I just said I would say. So
I would say, sorry. Yeah, I was just having a quick skim through. I think we've covered everything, unless there's anything that we've missed out at this point, but I think we've got it all now.
Yeah, no, I think that's kind of, we did everything. Like, I'm looking at the notes here, and we did touch on most of it, and I'm happy with that. I mean, for the people looking at this, we did jump a bit all over the place, but I think that's kind of what's good about it, because if you're just going through it just step by step, it can be a bit boring, and sometimes, you know, things just kind of jump into our head and then we cover it then. But I think as long as we sort of cover most of it, I'm pretty happy with that.
Oh, this has been quite fun. And just before we go, do you want to just remind our viewers where they can find our reports again?
Yeah, just go on the website. Well, no, I have to. I'm not sharing it. Let me. Using the website now?
Yep, perfect.
Yeah, so just go here on hpvalueinvesting.com. You have the reports. We add blogs here, that sort of stuff. If people have any, feedback, feel free to give us that. If they have any recommendations of companies they want us to look at, please let us know. And we can do videos like this. And this is only our second one, so I guess we'll learn as we're going, and hopefully my camera will work the next time.
Yeah, step by step. And it'll be nice to know what kind of companies you're interested in as well. So yeah, anything's welcome.
You guys and the viewer, right?
Yes.
Yes.
Do you want to scroll down? I can't quite see the Ashtead report. I can only just see the top bit.
Yeah. Just yeah.
Ah, there we go. Lovely. Cool. I think that wraps it up.
Yeah, that's about it. Okay. Thank you for watching, everyone.
All right. Thank you. Bye.